Hi, everyone, and welcome to the Wirex Crypto Podcast. I'm your host, Lianna, and I'm very happy to introduce our guest for today, Georges Chouchani, founder of Euclid Protocol. Welcome, George.
Yeah, thank you, Lianna, for having me on board.
Today, we're breaking down the complex world of liquidity in crypto and exploring whether the industry can escape its self-destructive cycles. We'll discuss what liquidity really means and why it's often viewed as a zero-sum game, and the community's desire for a stable liquidity. Before we start, George, could you share a little bit about your professional background and how you ended up diving into crypto?
Yeah, sure. So basically, I've been a blockchain developer in the space for about five and a half years now. Before that, I was a Python engineer, but my career didn't last long enough there. I started doing some hackathons with friends in the weekends, and then basically stumbled into blockchain, and we basically built a very simple, primitive music copyright platform as NFTs, and we presented it to the hackathon. It was an online hackathon, and we got, I think, second place. And a engineer out of Canada reached out to me, said they just raised for their startup and they needed an engineer to help them part-time build their smart contracts, and if I want to join as a junior engineer. And I was like, yeah, sure, why not? So I just left my career in Python and in Web 2 and just dived all the way into Web 3 since then. I've worked with over 10 startups in space. I've led teams, I've led small teams and big teams across the ecosystem, and then started my own dev shop. I've worked with over 10 startups around the world, helping them build solutions that scale with my team. And now here we are. I started Euclid Protocol, aiming to basically solve the fragmentation of liquidity across the entire ecosystem.
I just love how sometimes, stories like yours always start with, I stumbled upon the blockchain. and what a great journey it's been. But to start, how would you explain liquidity in the crypto world to someone new to the space? Why do some call it a zero-sum game, for example?
Yeah, so liquidity basically is kind of an abstract concept, but in Web3, we try to quantify it in numbers. But basically, liquidity is the ease of, converting one asset to another. So if I have potatoes and I can go to a market and sell this potato in 2 minutes, and I find a buyer and we agree on a price, then we can call the potato market, highly liquid or with high liquidity. And while if you can't sell it and there's a lot of people trying to sell their potatoes and nobody's buying them, then this is a highly illiquid market, right? So this is what liquidity basically is. And traditionally in Web 2 finance, big market makers basically determine the liquidity of the market. So they just buy low and sell high, and they make a profit of the difference. And they created I would say liquidity for these assets to be traded by any trader or any fund or anybody else. While in crypto, thanks to brilliant minds, we were able to create a system where anybody can, if they have assets, anybody can now become a passive market maker, right? Without having to put in trades and manage everything, and they could do it passively through what we call automated market makers, which is just based on mathematics, right? So the price of an asset is just a formula which is based on how much currently exists of both assets, and it determines the price and how much you can buy and how much the liquidity providers or market makers would earn fees. So basically, because crypto became predominantly passive market making, liquidity is now defined as how much of these assets are actually provided to be traded, right? And this is what we call now TVL. So when you hear that there's a lot of liquidity in blockchain or low liquidity, basically what we're talking about is total value locked. So when you basically have somebody who is providing liquidity on the blockchain, he's acting like a market maker and earning fees on it. So this is what we call liquidity. Now, people call it a zero-sum game because when you think about right now all the markets that exist, you have 20, I think 2,000 blockchains that currently exist, right? And all these blockchains have their own decentralized markets in some sense. So each of these blockchains are actually allow people to come in and trade against liquidity which users have added to this blockchain. Now, before there were only 3-4 blockchains. So it was okay because everybody only added liquidity and traded on these blockchains. So it wasn't that fragmented or divided back then. But now with 2,000 blockchains, there's so much choices for liquidity providers to put in liquidity, right? that now it's a hard choice where to put it. And they're trying to find basically where is the most ROI for me to put my assets to be traded on, right? And basically for a market to win, they just need to have more liquidity than the others. So the market with most liquidity usually earns the most fees and basically wins the most market share of users. And now we call it a zero-sum game, because a zero-sum game basically means that when you have the whole system, so the sum of all markets, the liquidity added to these markets is equal to the liquidity taken out of these markets. So there's no liquidity being added and there's no liquidity being removed. And we have seen over the period of the last 5 years that this is the case. There has been new liquidity added to the blockchain and zero liquidity removed from this, from the blockchain ecosystem. So what happens is basically it's only all these markets fighting for the same share of liquidity. So you have this chain fighting for this chain for the same users and same assets. And the issue that this has caused is when you have a zero-sum game, competition is fiercely increases and people pay much more money in incentives and bribing and advertising, whatever you want, basically to attract these people. And then millions of dollars are wasted, number one. And two, the user has a very bad experience now trading on blockchains and trading back like on TradFi, on like Web2. So this is what we call a zero-sum game.
Wow. First of all, I didn't know that there were 2,000 blockchains right now. And thanks for explaining the zero-sum game. It's made so much sense now. But from your experience, what drives these intense cycles of liquidity in crypto?
Yeah. So when you talk about cycles, I think cycles are like there's highly liquid. So there's times when the market is highly liquid and times where the market is highly illiquid. But as we have seen, due to the zero-sum game, it's not the entire market which is highly liquid or highly illiquid. It's basically segments of this market. So there's basically chains which are suddenly very liquid and then they become very illiquid, and then it just keeps on moving on from one chain to another. And the reason is, as we have said, because all these chains are fighting for the same liquidity, when a chain launches, it basically has a lot of tokens and money to offer to these liquidity providers to attract them here. So liquidity providers their only goal is basically to make as much money as possible. So what they will do is they will basically just see where their assets will generate the most revenue, for them. So what the chains do to attract these providers is they just give too much incentives. So if you come and provide your assets here, we'll give you a guaranteed 10, 20, 100%, even we have seen 500% APR on your assets. And this is the issue that happens, is that they're able to do that for 1, 2, 3 months, the chains, and the assets will actually move there. But then this is unsustainable, right? You're paying this is now millions of dollars you're paying every month for liquidity providers. And then what would happen is you would dry up of tokens, you cannot give incentives anymore, and the fees would not generate enough revenue for these liquidity providers to stay here. So what they would do is a new chain would come up next, and then with new incentives, and they would just move there. So these asset providers are just moving from one place to another, jumping between these chains, I would say just maximizing their profits, while the chains and users are just left behind and paying all the money and losing on experience, on fees, on slippage, and even exploits, right? So this is what basically drives these intense cycles. It's just new what I would call new ecosystems or new networks, blockchains, creating incentives, making liquidity move there. People see a cycle there, see a narrative, what I would call it, and think there's hype there, move there, and then it will just move on to the next best thing 3 months from now. So this is why it's a very unscalable, I would say, system that we have right now. It's very costly, and this is why we're not able, I think, to have what we call stable liquidity.
Yeah, and I feel like it's not very sustainable, if it keeps going this way, right? And how much do you think the community actually wants stable liquidity? Could it be that the highs and lows are a bigger part of crypto culture than me?
Yeah, so basically, I think stable liquidity is the essence of sustainable blockchain, of sustainable finance on blockchain. If you don't have stable liquidity, you won't be able to actually sustain any users and bring on institutions and retail users if you want to. Stable liquidity is how I would say it. So stable liquidity comes from a lot of sacrifices that chains, liquidity providers have to do. it means having to short-term feel, I would say, pain. It's not pain, but have short-term reduced growth, and then long-term they would see basically they will reap the benefits of stable liquidity. And to do that, I can talk later about how to do that. But for the community, it's extremely important because low illiquid moments on a chain is basically killing a chain. Because if a chain doesn't have liquidity to onboard users and applications and ecosystems on top of it, that is going to die pretty shortly. This is what we have seen over and over with all these blockchains. You hear about a blockchain for 1 year max, and then you don't hear about it anymore. And the reason you don't hear about it anymore is because liquidity has moved on through providers, to users, to whatever it is. So for chain, stable liquidity is extremely important. For users, extremely important. For liquidity providers, I think they are benefiting and exploiting the situation because right now they're making 100%, 50%, 40% a year, which is a crazy amount, right? Due to the incentive mechanism we talked about. And I think they're going to hurt the most if stable liquidity actually comes.
Wow. And what role do you see DeFi protocols or CrossChain Solutions playing in making liquidity cycles more stable? Are they really helping or just adding more layers?
Yeah, so basically it depends on the CrossChain solution, right? So we've seen bridging trying to help move assets from one ecosystem to another, but I think bridging just makes the solution actually worse because right now so bridging just makes it easier to move from one cycle, if you want, or from one network to another. And this has I think, increased, I would say, the issue that we have talked about, which is the incentive issue, because liquidity providers can now move assets even easier when they find a better APR. So it makes it even more unsustainable. But there's other CrossChain solutions that are being built, which I think, bullish on. I think one of them is what we are building, which is basically trying to create a shared liquidity layer, which basically allows everybody to tap into the same source of liquidity. It allows everybody to be able to share the cost and also reap the benefits of liquidity instead of having the user go to different blockchains to access it or liquidity providers. They could access it from anywhere. I think this is one of the biggest solutions to allow for stable liquidity and to allow for the market to grow, right? And change, I would say, this zero-sum game where everybody's fighting to a positive-sum game where everybody grows when somebody grows. And I think this is how it should go. I think if you look at traditional finance and what they did with the stock market, this is basically what they did. They consolidated all of these clearing houses and markets into 2-3 big exchanges, which now handle 99% of the volume. And this has basically benefited the stocks, the users, and the traders.
Would you say, also this is kind of it speaks to collaboration over competition in a sense, right?
Yeah, because for me, the market is still very, very small. Like the market today compared to the market 10 years from now is like less than 1%. I'm very bullish on decentralized market finance, and that in 10 years from now, 90% of all assets, equities, commodities, whatever you want will be now traded on the blockchain. So if we're fighting right now, there's no roadmap to even reach and grow and basically scale to the numbers I'm talking about.
Yeah, that really makes so much sense. So if you had to give up one key feature of crypto to stabilize liquidity, what would it be?
Okay, good question. So I think that the key feature that I would say the market would have to give up is, I would think, fast individual growth. So incentives can bootstrap short-term your growth, in a huge way. You could get a lot of users, a lot of millions of dollars in liquidity, hype, attention. But that's, I think, very short-sighted growth and very unscalable growth, right? Because at the end of the day, you're going to get drained. You're not going to have any more money to pay for it. And somebody else will just come in and take the spotlight from you, right? While if you share liquidity, your growth is never going to be the same as if you did it yourself. You're going to share fees, that you earn with others that maybe they don't deserve as much as you. You might think that. And the whole ecosystem will grow, but you will grow way slower. But then this is short term, you would see it as a loss. But then long term, instead of dying in a few years, it would actually be way bigger if you followed the collaboration way with other chains. Just really find liquidity in a way that is sustainable for everybody to be able to grow at the same time. And you might have, and as I said, you might grow, 50%, 80% slower, but at the end of the day, you'll be actually able to sustain this growth over 5-10 years. And then when the big liquidity comes, and then when, commodities come on chain, it doesn't matter, right, how much you have, because there's enough liquidity, like this trillions of dollars of volume every day. You won't care about market share that much, basically.
I really love the outlook of taking a loss for the short term for a long-term profit in that sense, and because sometimes I feel like, we do get very short-sighted and we just want the wins right now, right? But we don't take that risk and say, yeah, let's collaborate over, competing with each other. That makes so much sense. Many think crypto is stuck in these cycles, right? But what if breaking out of them could destroy some of the industries like appeal? Would a stable crypto market still be interesting, you think?
Yeah, so it will lose its appeal for a large amount of people who use blockchain, which are, I think, speculators and gamblers. For gamblers, it's going to be, oh no, now, because cycles of liquidity basically means higher volatility of assets, which means more leverage for me, more money to try and make, even when higher losses, but also higher wins. So it's like a gamble. It's like a casino now. Just, meme coins, some are liquid, some are highly illiquid, moving from one chain to another, getting APR here, getting incentives there, airdrops. So all of that is very attractive for a subset of people on blockchain. But this is, again, as I'm saying, this is good to maybe bootstrap it, but this is definitely not a long-term solution. And this will hurt crypto long-term, focusing just on cycles of being afraid to move away from this volatile market over to a more stable market where we can focus on, stable long-term, growth. So yeah, it will lose its appeal for a lot of people, let me say, but then it will gain appeal for institutions to come in, for, big funds, and real long-term players in crypto. And this is what you need. You don't need gamblers and speculators. There's always place for them, but most of crypto should be basically focusing on moving finance into decentralized markets, because this is better for privacy, better for efficiency, and just a better way to go of things.
Just as you were saying that, for me, something that came to me, and it was like, weed out the greed.
Yeah.
And if we somehow solve the liquidity cycle overnight, right? What do you think the next big challenge for the crypto space would be? Because, as we all know, there's always something, right? It's always kind of like waiting for the other shoe to drop. I'd love to hear your thoughts on that.
Yeah, so again, when I think about all these questions you're asking me, I think about a 10 to 20 year timeline. So let's say we solve the liquidity issue, we're sharing liquidity, everybody's happy, we have stable market. Now we're getting liquidity onboarded into blockchain. We're getting billions of dollars being funded, added into the decentralized markets. Now we need to be able to have the infrastructure and applications, be able to scale that, right? When you get to $1 billion in liquidity, you don't only get the money, you also get the users who want to trade against it, right? Which means much more transactions, much more requests happening on the blockchain, which I think can be unscalable for some blockchains. And we need to make sure that we are actually able to sustain that. So I think infrastructure is going to be a big play after liquidity. Also, of course, user experience is also very important, because right now, blockchain still did not, I would say, so blockchains didn't actually solve the user experience yet. It's still very hard to navigate through blockchains and move from one chain to another. So now we're seeing more solutions on chain abstraction, kind of unification of assets across blockchains, better user interfaces. All that is very important as well to onboard basically, my grandmas or normal people who have no idea about technology. So that's also, let's say, the next big struggle that blockchain will face. It's a struggle now, but then when you get liquidity solved, it's going to be even bigger of a struggle, because you have much more people, normal people I would call, trying to tackle it.
But I think, I say this all the time, that we're still building the plane while flying it, right? And I think this is why we have people like you to kind of look at the future and also pinpoint the different challenges, to make this industry, this crypto space a bit more sustainable. So I do want to say thank you for that, right? If you could go back to the start of your journey in crypto, what advice would you give yourself about navigating the liquidity landscape?
So I think early on, like nobody, not only myself, but nobody thought about, how big of initial liquidity fragmentation would be. Today, it's apparent because, as I said, we have so many blockchains now, and everybody wants their own blockchain. Everybody wants to have their own consensus layer, right? And now it's very easy to do so. Back then, like if you told me there's going to be 2,000 blockchains in 3 years, I'll tell you you're crazy, right? But now it's we're currently there, and we're scaling even faster. Like nobody expected, building chains would be much more easy than attracting liquidity. And I think I would have, it's not only for me, I would have send a message to basically everybody back then, like all the teams that were working on solutions and in blockchain, to tackle this issue earlier, because I think this liquidity fragmentation did set us back a few years, focusing more on short-term gains, like, again, speculation of assets and the zero-sum game has set us back a few years. We could have accelerated faster. So yeah, I wish we knew that earlier, but then again, we can't predict anything. And I think we're still very early now. And we're trying to solve a solution, like my team, other teams. Like there's a lot of very promising solutions coming out on the blockchain, and I'm very bullish on them.
Yeah, and also, it makes me think about, you don't know what you don't know, So I think in this journey, it's really about, recognizing these different challenges and tackling them as soon as we see them, right? And just making sure that it's a safe space for everyone involved. Yeah, and finally, is there anything else you'd like to share or any closing thoughts?
I would like to say that if you're everybody listening to this and is very interested in the state of liquidity and blockchain, I would say be optimistic. I think there's a lot of solutions on the short term coming that would be very promising to be able to scale. There's a lot of big institutions, BlackRock, PayPal, a lot of big funds coming into blockchain with a lot of liquidity, and people are trying to solve this for them. So I think this is very very positive. I wouldn't be afraid at all. I don't think blockchain, some people fear blockchain, and if there's too much liquidity and exploits, I think blockchains are 100 times more safer than any traditional market that currently exists. So yeah, again, I'm going to say it again. I already said it many times, but I'm very bullish on decentralized markets, decentralized finance. And I hope, I wait for the future where everything becomes on-chain and you own it instead of organizations owning it for you.
George, it's been a real pleasure having you on the podcast. We really appreciate you taking the time to share your knowledge with us.
No, thank you for having me. It has been a pleasure.
And to all our fantastic listeners, I hope you've enjoyed this conversation. Don't forget to express your support by liking, subscribing, and sharing this episode. Thank you for tuning in, and until we meet again, stay well.